My name is Dr.K.Karpagambigai, Assistant Professor, Department of Business Administration, Dr. S.N.S. Rajalakshmi College of Arts and Science. Now we are going to see about the equity shares. So already we seen about the equity shares, also known as a common stocks, represent ownership in a company. When you purchase equity shares of a company, you are buying a stake in that company and become a partial owner. Equity shareholders have the potential to benefit from the company's success but also bear the risk of its failures. Key features of equity shares ownership. Shareholders own a portion of the company. The more shares of you own, the larger your ownership percentage in the company. Voting rights. Equity shareholders typically have the right to vote on important company matters, such as electing the board of directors or approving major corporate actions. The voting power is usually proportional to the number of shares owned. Dividend payments. Companies may pay dividends to equity shareholders typically as a portion of their profits. However, dividends are not guaranteed and depend on the company's performance and its bonds of directors' decision. Capital appreciation. Equity shareholders can benefit from an increase in the market price of shares. If the company performs well, the stock price may rise, allowing investors to sell their shares for a profit. Risk. Equity shareholders bear the risk of the company's failure. If the company goes bankrupt, shareholders are last in line to receive any remaining assets after creditors and bondholders are paid. Equity shareholders may lose all or part of their investment. Types of equity shares. First one, common shares. These are the most common type of equity share. Holders of common shares have voting rights and are eligible to receive dividends, although dividends are not guaranteed and prepaid out after the company's debt and preferred dividends. Preferred shares. While technically a type of equity shares, preferred shares offer a different set of benefits. Preferred shareholders receive dividends before common shareholders and are typically paid a fixed dividend. However, they usually do not have voting rights. How equity shares work? Initial public offering. When a company goes public, it issues equity shares to the public for the first time through the IPO. This allows the company to raise capital for expansion, acquisition, or other business activities. Secondary market. After the IPO, equity shares are traded on stock exchanges like the others. Investors can buy and sell shares in the secondary market, which allows for liquidity at prevailing market prices. Advantages of equity shares. First one, over time, equity shares have historically provided higher returns compared to other asset classes like bonds or saving accounts, especially for long-term investors. Ownership and voting rights. Equity shareholders have the right to vote on key company decisions and participate in the company's growth. Liquidity. Stocks can be easily bought and sold on public exchange, make them more liquid than other forms of investment like real estate. Diversification, that is, stocks can be easily bought and sold on public exchanges, making them more liquid than other forms of investment like real estates. Risk of equity shares. Market volatility. Stock prices can fluctuate widely based on market conditions, company performance, and broader economic factors. This volatility can lead to short-term loans. Dividend uncertainty. Companies may decide to cut or eliminate dividends if their financial performance weakens. Unlike bonds, dividends are not guaranteed. Potential loss of investment. In the case of company failure or bankruptcy, equity shareholders are the last to be paid and may lose their entire investment management. How to invest in equity shares? Here, to buy and sell equity shares, investors must open an account with a brokerage firm. Many